Hey guys, Whitney here. Welcome to the Passive Investing Made Simple show. If this is your first time joining us, we're just going to give it a minute or so for people to get into the Zoom room. But we record this show live every Tuesday to go through the ins and outs of passive investing so you can go into your first or next deal with confidence. So while we're waiting for everybody to join the room, if you haven't already done so already, make sure to join passiveinvestingwithwhitney.com. There you'll get to see all our other future masterclass episodes that will be posted, as well as you can check out our open deals at passiveinvesting.com. And if you'd like, hop on the phone with me. Now, today's episode, we are going to talk about the accounting piece that operators perform on behalf of limited partner investors. Now, big disclaimer, this is not a place for us to discuss your personal tax situation. We are not accountants. You still have to hire your own accountant team. However, with that, I want to bring in our very special guest, our Director of Finance, Tao Brody. Tao, thank you so much for joining us today.
Hi, Whitney. Hi, everyone. I'm really excited to be here today.
Well, fantastic. Well, so Tao, I want to just start off, I don't want to just dive right into everything accounting and especially going over the K-1. Let's talk about, because you're a real estate investor. Tell us a little bit about your journey and how you came to be here at passiveinvesting.com.
Yeah, so I want to just start this off by saying I'm not a tax expert. I'm not a tax specialist. I wouldn't even consider myself a tax CPA, but I am a licensed CPA, and my background is in audit. I started with Deloitte. I worked for Deloitte for 5 years, auditing the financial statements and internal controls of public companies primarily. I was never preparing the tax returns, but I was always the lucky auditor tasked with the section of the audit pertaining to testing the design and effectiveness of the tax controls. So I've always worked very closely with tax teams, and I moved from Deloitte into private equity, and then private equity into real estate private equity, where I really just got my feet wet in the real estate world. Learned very quickly that I was very interested in it, and I picked up 3 of my own personal investments in the last 2 years, so that I would have the knowledge as an LP as well as the knowledge from the corporate side that I deal with on a day-to-day basis. So yeah, that's a little bit about me.
Well, excellent. So you can bring knowledge from both worlds, but again, nothing that we say here today will replace the knowledge and the relationship that you have with your tax experts. We're really just walking you through some of the mechanics of what we perform here, what operators in general perform on behalf of their limited partner investors. And then we're going to start picking apart the K-1. If you are joining us just audio only or on your favorite podcast player of choice, I really highly encourage you to go find the YouTube video of this presentation. And that way you can follow along when we start dissecting the K-1 and what you need to be on the lookout there for. But let's really just start kind of high level. So Tao, just walk us through what your function, Director of Finance, does. What type of accounting do you perform on the behalf of the limited partner investor in a passive investment?
Yeah, I'm excited to be here because it's cool to give an inside glimpse into what goes on in the finance department, just because most people aren't that interested in what we do as the finance team. So we do work very closely with several of our departments as well as our property management teams. So we kind of have like the corporate finance responsibilities as well as the operator responsibilities. So I'll try to stay in my lane, but just know that there is a lot of overlap from the origination of closing on these properties to negotiating the loans to signing the loans, and then all the way to the actual day-to-day operation. So once we close on an asset, we first make sure our cap tables are in line so that we have all of our investors recorded with their appropriate contribution amounts, their ownership percentages, and have all that basic information in our systems. And then we'll start from day one immediately funding the accounts for operations. We'll immediately start paying our vendors. We will start the process of making those loan payments, doing the accounting for all of our loans, confirming any rate cap payouts as applicable. And then it just compounds from there. So every month to every quarter, we will be calculating and distributing and the distribution amounts to all of our investors, dealing with any banking issues, which always there might be bank accounts that close, or there's routing number issues, or the bank account name was cut off, or there's issues with the custodian name not being included in the investor name. So all those kind of nuances of the first distribution and the subsequent distributions that come along after that. We do have third-party property management teams on the ground at each and every one of our assets. They are the ones that are doing all the day-to-day operations. So they're collecting the rent, they're chasing down the delinquent rent payments, they're making sure that our units are staying occupied, they are dealing with all the repairs and maintenance, they're literally doing everything that that needs to happen in order to keep these assets operational. Where we come in is sometimes, for example, the loan payments might be due before we've collected all the rent. So we'll need to fund the account in order to make that loan payment. Conversely, which is the case that we hope for, is that we've collected all the rent, we've made all the payments, and the PMs are now sweeping all the excess cash to our account at the corporate level so that then we can distribute those funds out to our investors. Moreover, all those day-to-day operations and all the bookkeeping performed at the property management level are then reported to us in monthly financial statements, which we then review and consolidate and deliver to our interested parties on a regular basis. So for our investors, that's a quarterly statement issued to them. Our lenders, we might send more frequent updates. Our insurers, our partners, everyone has needs to see and have transparency of the financial statements. Something to note, for our car washes, we've had some investors say we want more transparency into the financial statements. So this month and last month, we have actually been in the process of implementing a new ERP or financial reporting system so that we can more easily obtain these financial statements, consolidate the information, and provide it in a very clean, transparent presentation so that our investors can see all the information that they would like to see on a regular basis. I know that's a lot so far, but there's a lot more. We do the tax planning and tax preparation, which I know we'll get into, and one of the reasons I'm here today. We obtain cost seg studies so that we can maximize our depreciation on all of these assets, which again, we'll get into what that means a little bit later. We also file all the tangible personal property tax returns, and we make the payments for all of those property taxes as well as the real estate taxes. We file all of the annual reports and periodic filing fees for all of our entities to keep our good standing status for each and every entity that we form. And we generate all the operating agreements. We track all the progress of our capital expenditures, pay those vendors, submit the draws on loans. And then when we sell an asset, we handle everything from the 1031 exchanges to the election to liquidate and keep track of all of that activity. So that's just a high level of a lot of different responsibilities that we have here at the finance department. But if you want to drill down into anything or into monthly, daily, annual activity, I'm happy to do that too.
Well, I feel like we wouldn't have time to do that because there's just so much.
There's so much.
Just to kind of put a little bit of a pretty bow on it. It's, end-to-end like financial management of the asset. And that is one of the things that I really wanted to bring you on here and really highlight is when people get into passive investing, and you're a limited partner investor, so you've experienced this as well. Those assets you're a limited partner of, you don't have to perform all those activities. But if you were to purchase those assets and be that day-to-day operator, you would have to perform all those activities. And so it's an amazing way as a passive investor to get exposure into real estate and to be a member of that LLC, get the distributions, get the equity distributions, but not have to have all those day-to-day operational and financial responsibilities. And so it's just a huge value add. And it wasn't until you and I sat down at our board meeting in last October, and I had, heard you give your presentation, I was like, man, I've been in this space for years, and I didn't put everything together what the finance department actually did for the investment. I was like, people have got to hear this.
Yeah, it's pretty crazy how much we do. And not that we're underappreciated, because I know everyone does appreciate us, but it's just not something people really think about in terms of all the money that's exchanging hands and all the different pieces and variables that have to fit together in order to keep this big machine running smoothly.
Absolutely. I think, I think for people that are new into this space, some think it's like you collect rent, pay the bills, give a distribution, and that's it.
Right.
Like,
right. I wish it were that simple.
I wish it were that simple, but it's just isn't. All right. Okay. So I want to pivot because I want to talk about a couple other areas before we dive into the tax piece, which is super timely for where we are right now in the annual cycle. People are preparing their tax returns right now. I know I sat down for hours preparing my own personal tax returns and asset preparation yesterday. But what are some of the challenges that, that limited that you handle, right? You went through all your responsibility, but let's keep it to the top 3 challenges that you handle, the fires you put out for the limited partner investor that they never see.
Okay. Yeah, the biggest challenges, one is probably trying to keep up with all the IRS updates. I know we're always trying to swerve and pivot. Like in last month, it was we don't need to issue K2s and K3s because it's only required for partnerships with foreign investors. This month, it's if you file your return on time, you have to file the K2s and K3s. So we're always just trying to be in accordance with the IRS, make sure our investors are happy getting the information they needed, but also file all these returns timely. And it's definitely a struggle, and it's not just my struggle; it's all of our tax CPA firms' struggle as well. But the IRS doesn't make it easy on any of us, as all of you know, also as individuals. The next would be probably tax related in terms of the real estate and tangible personal property tax filings. So each and every year, we're filing these tangible personal property tax returns for all of our assets. All of our assets are located in different counties with different sets of due dates, requirements, forms, how to define tangible personal property, different appeal dates, different people reviewing the form. So for the numerous properties that we do have, each and every one has a very special, different, unique set of filing requirements. So that's what we've been spending a lot of our time on these last 2 months, is just making sure we have the proper listings of the personal property details, and making sure that we're filing them on time and getting them reviewed on time, and bringing in necessary third parties as applicable. And that is something that I didn't really see much activity in last year. And it has taken a lot of time, and it has been challenging just trying to get acquainted with the various counties. The next challenge would probably be just maybe the distribution to investors process. If it's a very clean closing where we hit our fundraising goal, we close on the date of closing, it's a very simple distribution calculation, and very smooth. But if we didn't quite hit that fundraising goal, we continue to accept new capital after close, the calculations can get a little bit more finicky in that now we're calculating the distributions based on the number of days that this one investor came in late to the deal, or trying to stagger the calculations to actually apply to the actual date that they were invested, which that can sometimes cause issues in IMS, which is the system that we use to manage our investments and our investors, with the ownership ratios and the cap tables. So it's really trying to make sure all that information stays clean, accurate, and complete, especially just with the size of our firm and the number of assets that we have and the demand to continue to invest in these deals and just keep that process streamlined can be challenging. That coupled with just obviously sending distributions to 5,000 different investors has its own inherent challenges, just in having the bank, like I mentioned before, having issues with the banks or custodians or closed accounts, or just a number of different challenges there.
You know, they're growing pains, right? Like
growing pains.
Yeah, as you know, and I can speak to this, you know, personally. Like when I brought in like my first like 1 through 5, even 1 through 10 properties, not that big of a deal. When you start getting 30, 40, 50 properties, big deal, right?
Right.
You hit a ceiling of achievement, and you're constantly needing a new person or process in order to be able to level up, right?
Right.
I want to make sure we save time and we get into the tax piece, because we have several questions that are coming in that are kind of more personal situation questions. And I want to make sure we leave plenty of time for ask me anything session. But let's transition to the kind of the more tax piece. Right. You've already kind of alluded to what's happening there, but walk us through what happens as far as preparing for taxes for this time of year. What can the limited partner make it do to make it easy on themselves, and then in turn, how does the timeline actually work? Because I think limited partners don't exactly understand the timeline here and what's involved.
Right. Absolutely. Before I get into the timeline, I kind of want to just paint the picture of what all is required to go into the preparation of the tax return first, so that they understand all the various inputs, and then I'll dig deeper into what is needed of the investors, if that's okay with you.
Let's do it.
Okay, so from a tax preparation standpoint, you're going to be sending all the formation docs. So that's the articles of organization, the SS4s, which are the IRS forms that include the EIN numbers, the org charts, any company agreements, the investor roster, which is the data source of everything that you see in your K-1 that has the investor's name, their address, their tax ID, their filing type, and entity type. So if it's an LLC, is it an S Corp? Is it a partnership? Is it a single member LLC? If it's a retirement account, their profit and loss percentages, their capital percentages, their contribution amounts, and any distributions for that year. Of course, also we're going to be providing the financial statements, which would include the balance sheet, the P&L, the TB, a year-to-date GL, the cost seg studies, the closing statements, any loan agreements, the purchase and sale agreements, and any TIC agreements as applicable. So that's just all of
the accountant.
This is just going to the accountant to prepare the return. So of that, the investor's responsibility there is making sure that the information included in our investor roster is complete and accurate. So if anyone here today is one of our passinvesting.com investors, you probably saw a notification email go out early, I think November, asking all of you to log into the portal and make sure the information as included in IMS is accurate. That was step 1 of our tax process related to the investor roster preparation and export. The information included in IMS gets directly exported into a roster and is then sent to the tax team. So if the information in IMS is not accurate, the information exported is not going to be accurate, which means the information in the K-1 will also not be accurate. That being said, given all the change of hands from the investor inputting data into the system to exporting the data out of IMS to then putting it into Excel to send to the tax preparer, which is then imported into their system, there is a lot of opportunity for mistakes to happen along the way. We have a lot of checks in place. The tax teams have a lot of checks in place, but there is always opportunity for errors to occur throughout the process. So it's not only important for the investor to check the information on the front end system, but also once the K-1 reaches them so that they can ensure that the information included in K-1 was exported correctly. Just in terms of the timeline there, so we asked you to check your information in November. We exported it as close to end of year as possible to try to, our goal was to send the tax teams as much information as we could prior to year end so they could get started on these returns as early as possible. So we were able to send them all the formation docs, all of the closing statements early. It's really just the investor rosters and the financial statements that require a little more time to fine tune and make sure that they're accurate as of year end. But most information was sent to the tax teams in Q4 of 2022, and they started working on that immediately. In terms of when we will start uploading those K-1s to the portal, that will begin occurring on March 1st and will continue to be uploaded as we receive the final versions through March. And just a reminder on the tax return deadlines, the partnership and S Corp deadlines are March 15th. If you extend, it's September 15th. So we will be filing all of our returns on March 15th. We will be uploading as many K-1s prior to that as possible, but there will still be some K-1s trickling in after March 15th. And then all of the individual single member LLC and C Corp returns are due April 18th. And if you extend, October 16th.
Yeah, so I think that's the timeline that people, especially if they're new into passive investing, don't quite grasp, right? And I knew I was in the same boat, right? Like the first year, I was like, okay, I know I'm getting a K-1, not a 1099. I'm used to my 1099 sitting on January 31st or earlier. All of a sudden, I'm in this new world where K-1s, what's that? Oh, it's a business. It comes with the filing and the business return. Those aren't, and at that time, it was actually those K-1s weren't due until March 31st. They've since moved up the deadline since I started investing. I'm an OG, I guess. So, now they're due a little bit earlier. But one of the things that I really appreciated are the operators who took the time and made sure that the tax returns were dialed in 100%, no changes, because the last thing you want is the operator filing an amendment in April, May, June, and now now you have to issue a new K-1. Ouch. Which means an amended return on the personal level. So yeah, it does take some time for sure.
Right, absolutely. Did you want to walk through the actual K-1 document?
Let's do it. Yeah. So if you're joining, on your audio only, this is the part where I really encourage you to go find the video and join in live, take a peek at it. Probably will answer some questions. I know we got questions coming in the chat and the Q&A. We will get to as many as we can in the time we have. If not, stick around for the after the Ask Me Anything session after we're done recording live. All right, Tao, let's do it.
All right, so I'm sharing my screen. Again, I'll try to walk through this verbally as much as possible for those of you who are joining us through a podcast. But I'm just going to go through the K-1 form just so you feel more comfortable with it. Again, none of us are tax experts here, but anything that I can help you understand, I'm happy to do that. So on the screen right now, I have part 2 highlighted, but I'd like to just start by talking about part 1 of the K-1. That's information about the partnership. So that's where you need to start. You need to say, do I recognize this partnership? Because if you don't, that is an issue, because that means the partnership has filed a K-1 on your behalf for an investment that you might not be invested in. So start there. Make sure you're familiar with the partnership. I know at passinvesting.com, the partnership names don't necessarily directly align with what you might think of as the property name, because we use a address type entity name, but that should be included in your investor management system and your portal or your PPM. So start there at part 1. Part 2 is the information that comes directly out of our investor roster and is input into your K-1. So again, this is your responsibility to make sure the information in this section is correct. The most common issues that I see here are, 1, the name or address is incorrect, so it might be in your individual name when it should be in your LLC name, or it is a retirement account, it is an IRA account, and it needs to start with your custodian for the benefit of your IRA account. Next would be the single member LLCs. So if you see here, section or letter E says, do not use the tax ID number of a disregarded entity. You need to be using.
Can I pause you? Because it looks like we're just highlighting on part 2. I don't know if your slides are moving through.
Is that better?
Yep, now we're seeing part 2, close up, fantastic. Okay.
Sorry, that's all I have as far as my Zoom functionality. So drilled in on part 2 just so you can see it a little bit better.
Excellent, thank you.
So E here is where the beneficial owner of a single member LLC should be included. So you have your single member LLC. It's a disregarded entity for tax purposes. You need to be providing us with the beneficial owner, whether that's you as the individual with your social security number, or whether that's a trust or an IRA or another partnership. That is a very common issue that we've seen at our level. And then also, if it is a retirement plan, make sure that little checkbox in I-2 is checked. So again, review this right when it is published by your partnerships, because what's going to happen more likely than not is you're going to say, I'll get to it. And then come your extended deadline date, you're going to say, oh, I forgot to review the K-1. And then you'll see that there's an error. And then at that point, it's too late for us to make a change. So I'd say try to review this within the first week of it being exported, because we can generate those changes if we know soon enough to do so.
So apart from like the social security, the name, the address, are there any other issues that an investor should kind of like review to make sure that are accurate in that like window?
In terms of the overall K-1 or just this section?
Just this section, the things that are within their control, right?
Right. Yeah, it's really just and the address doesn't really matter. If it has a misspelling, it doesn't really matter. Your own tax CPA can make those tweaks. We do like to see that your social security number, your EIN number for your investing entity or your investment is in the correct number, but you should be able to still file your return and make those changes on your end. It is just if you can report these issues to us sooner rather than later, we can make those adjustments. Okay, going forward, this section J, it's directly below the partner information section. This is where you can see your profit and loss and capital percentages. So in the first year that the asset is acquired, the beginning percentages are all going to say 0, and then your ending percentages will show what your capital versus P&L percentages are. So your capital percentages are typically going to be higher than your P&L percentage, because capital is just your contribution amount divided by total equity, whereas your profit and loss percentage has the manager's interest included. So Year 2 of your investment, the beginning and ending percentages should agree. There are exceptions if we're continuing to accept new capital or if there are redemptions during the year, those percentages may change. And then in the year of sale, your ending percentages should show 0 if you are a liquidating partner. The next section, I'm not really going to dig into this. It's the debt section. Really, this is not going to be applicable for you as long as your basis is positive. So if your ending capital account balance is positive, not really applicable. It's when your capital account balance goes negative that this comes into play, because this is what your tax CPA will use to determine your basis. So we're just going to skip that section for now. And then next, I want to dig into the partner's capital account analysis. Again, this is where you can better understand the basis in the asset. So in year 1 of the acquisition, your beginning capital account balance will be 0. The capital contributed during the year will be equal to your investment amount. And then your current year net income or loss will be the loss allocated or income or loss allocated to you from the partnership. Typically, in the first few years, the partners will see a loss here. This is primarily related to bonus depreciation. So as I touched upon earlier, we do get cost seg studies for all of our assets, and we will maximize depreciation in the first year. So while you may see a substantial loss in year 1 here, it is not truly indicative of the performance of the asset. It is related primarily to the bonus depreciation that we are taking that year. And you'll continue to see that loss kind of trickle out as the depreciation reduces and the actual income from operations is a more prominent number here in this calculation. Next would be the withdrawals and distribution. So that would be any distributions that we have sent to you during the year. Many investors will do a reconciliation between the distributions that we send them and what is actually input on this K-1. Any investors here today that invest with passiveinvesting.com, you can go into IMS in your investor portal and export a detail of all the distributions sent to you and agree that back to your bank records. And then all of that will net out to your ending capital account balance, which should agree to the beginning capital account balance of the following year. So just some items to note here. I noted that you'll often see losses in the first few years. Those losses, if you don't have any passive income to apply them to, they can be used in future years. And if you never have any other passive losses, then you can use those losses to offset the gain at the time that we sell those assets, or at the time that we sell that asset. And if you ever want to get a full picture of how the life of your investment, you could put together an Excel spreadsheet showing the losses that you were allocated throughout the life of the investment. And you'll see at the end that those losses would essentially offset the gain in the year of sale. This is advice. I'm going to just say this from an organization standpoint. It is your responsibility to make sure that you're tracking all of your losses. We have seen investors switch CPAs and basically, if you switch a CPA and you haven't kept track of your losses, they have no idea that we've allocated a certain number of losses to you in prior years. So it's very important that you and your CPA are tracking these properly, and your CPA should be reporting all your losses on Form 8582. But it is an opportunity for issues to occur if not tracked properly.
I would 100% echo that statement. This is the best time for you to get a high quality real estate savvy, syndication savvy CPA to help you keep track of all this, because it can be one, very overwhelming to try to do it all yourself.
Right.
But two, just so you can keep these numbers all in check, because that is the power that many of us are after here, is utilizing that depreciation to offset passive and other forms of income.
Right. Absolutely. Well said. The next, I just want to highlight the boxes that, again, that you'll mainly note allocations are included just based on your passive investment. We have box 1 and 2 for passive income for our multifamily and our storage facilities. Those are all income from rent. So you'll see the bulk of the activity is classified in box 2, if not all the activity, because that is a rental real estate income. Other types of assets, like you may see for our hotel and car washes, will have income recorded to box 1, still passive income because you are a passive investor and a passive LP, but it's a different type of income, not driven by rental. Next would be any interest income. So any cash that's sitting in the account, maybe making interest from the money market or other income streams, that will be recorded to box 5. Usually it won't be substantial. Next would be box 19. That's where your distributions will be reported. Again, we saw your distributions in the calculation for your capital account. The distributions are offsetting the capital, so it's the return of your capital. You're not getting taxed on those distributions. Next, there's typically information included in box 20. Really, that's related to qualified income business deduction that I don't really want to get into today, but fundamentally, your CPA should be reporting this information on Form 8995, but continue to consult your CPA for limitations on those deductions. Lastly, when in the year that we do sell the properties, you will see box 9A and 10, which are the net long-term capital gain and loss, and the net section 1231 gain or loss fields filled out, because you typically will see a gain in the year of sale. So sorry to rush through all of that, but any questions, Whitney, that you can think of?
We have a myriad of questions, and they're generally like individually related. Like, if I have this, the type of entity set up, what should I pay attention to?
Mm-hmm.
So what I would love to do at this point in time is just kind of wrap up with some general advice, and we can move to our Ask Me Anything section of the program. Guys, if you're joining with us here live, don't go anywhere. If you're listening to us on your favorite podcast player choice, or you're watching this on YouTube, Tao, my last question I have for you is, what is the number one thing that you want investors to take away from our conversation today? To make the tax process to go, maybe let's continue around taxes, to make the tax process go much smoother.
Right. I would say make sure you're reviewing your K-1. Don't let it sit till the last minute. Work with your whoever that might be, the partnerships, to make sure that the information included therein is complete and accurate, because that seems to be the biggest hangup that we have once we issue these K-1s is, it's in my LLC's name. Just straighten that out before year end, and then make sure that when these K-1s are uploaded, you're reviewing them in a very timely manner. So that's my one ask and one takeaway from today.
Awesome. All right. So guys, if you're here live, I just want to say thank you for taking the time out of your day to not only invest here with us and to learn about this very powerful finance process that we have in place for you. We're all trying to build our wealth together, but more importantly, for investing in yourself. Tao, I want to thank you for joining us here live. Don't go anywhere. If you haven't already, make sure to register at passiveinvestingwithwhitney.com to get access to future masterclass sessions and to check out our open deals.